Record rally taking a breather this week with the Dow and S&P 500 falling hard for the third straight day. And if you think this is the beginning of an even bigger pullback, our next guest says he's got a few ideas on where to take cover. Fundstrat's Rob Sluymer over at the Plaza to break it all down. Hey, Rob.
Hey, Melissa, thanks very much. So let's take a look at the short term. Pretty much every technical analyst on the street's been worried about this little short-term peak developing. I think it's really important we keep it into context. So here's the market starting to come off just a little bit. A lot of support down in that 3,025 range. I'm not sure we're even going to get down that far. We're still pretty bullish on the market. We have been all year. And we think the playbook that we saw in 2019, where we get these momentum peaks here and here and here and now here, is unlikely to give us the same sort of pullbacks that we saw through the bulk of 2019. Why is that? Well, if we take a look at the longer-term chart, we think the playbook's changed. And we've used this chart a number of times before, but what's really important here is this long-term picture of the S&P in the top panel. That's the 200-week moving average. It tracks the 4-year average for the market, and it's such a good barometer for where the long-term support is. We saw it in 2011, we saw it in 16, and we saw it in 18 as well. So we think coming out of this trading range, we're still in a whole new market cycle, and we're in that second up leg. This indicator in the bottom, not that many people follow it, but it's a Copic curve. And it's a very good way, at least we found it very good over the years, to track when we're getting into these cycle lows. There was one back in 2011 and 12, another one in 16, and down in here. This cycle should carry us out into 2021, 22. So we still think there's more upside for equities in general. However, there's a lot of people that are still concerned about the market. Caterpillar is not a defensive name by any means, but the key point here is we still think we're not going to see that much of a pullback. So this downtrend's been broken. You're getting a little bit of a pullback. In fact, what was interesting today when the market was down, the semis were getting hit, cyclicals were up, banks were up, and yields were up. So we still think there's more upside in these cyclical names. Maybe a little volatile, but we still think they're going higher. That relative performance trend that's been in place for 2 years is reversed. Very similar to what we saw in 2016. So if you're concerned about the market, I can understand not wanting to buy Caterpillar. Our view is it still goes higher well into the first quarter. But you want a defensive name? I think J&J is well suited right here, right now. There's that 200-week moving average. It's sitting on it. For reference, if you think about what Nike did in 2017, that's the exact same spot before it took off. And that's exactly where Disney was in 2018, just hovering around the 200-week moving average and getting ready to go. Sure, it's weak. It hasn't had a lot of performance, but that's exactly what Nike and Disney look like over the last couple of years. So defensive name, I'd stick with Johnson & Johnson.
Rob Sluymer, come on over.
Bring him over.
Bring the chair over, as he so aptly does.
You know, Will got the remember I mentioned he hurt his head, he hit his head.
He got staples.
He got staples. He had the staples removed.
So
so Will is all
his red head.
Okay, I mean,
Anyway,
he's not a redhead.
He's reddish.
Neither here nor there. Neither here nor there. I understand you're a technical strategist, but when you present these ideas to clients, what's their reaction? I would think that that you get a lot of pushback
On
to
the
these two
cyclicals?
particular
Laughing
names.
at you.
Just on Johnson & Johnson and Caterpillar, because Caterpillar, for one, is in the crosshairs of the China trade war.
100%.
Johnson & Johnson's got all this litigation risk. I mean,
Right. So we've been bullish on cyclicals through the year. I think we got the semi-call fairly well throughout the year. The turn in the cyclicals looks very long-term to us, at least through 2020. We see it with names like JP Morgan breaking out a big trading range. The pushback is tremendous. Nobody wants to own deep value. Nobody wants to own cyclicals. And I tell you, if you look at the charts, they look pretty convincing to me, particularly from a long-term standpoint. I can understand we get a bit of volatility into year-end around some of these names that have run. I think Cat's up, 26% off the November lows, October lows. And then on J&J, yes, there's pushback. But I think that's great. That's what we want to hear. We want to hear people don't like these names. That's how people get back into the stock.
So are you saying that, let's talk about if something goes wrong with China trade, right, that the cyclicals have a different risk reward built into them at these prices than the market on a whole?
I think we have to make the assumption, and it's an assumption that if
it could be.
if trade goes bad, these stocks are going to get hit. But again, if you step back, a lot of these stocks have been under pressure for 2 years. And while trade has been part of the issue, I think a lot of it's been the economy and the backdrop. When you talk to Tom Lee on the Fundstrat on the fundamental side, the ISMs look like they're about to bottom. I think it's more about the economy than it is about the trade deal. So yes, there'll be volatility, but I don't think they're going down that much.
So, Rob, it seems like the same part of that trade would then also be Germany and trade economies.
Yes.
Would
EM.
would be emerging markets, would be a FedEx. I mean, do you feel the same way are these charts all similar to you?
Very similar. Most of them, FedEx is a little bit of a different animal, but generally when you go across the industrials and the transports, the banks, it's the same profile, 1 to 2 years down, right to their long-term secular uptrend, which I think is really important. Germany is somewhat similar. EM looks the same way. And part of that trade is I think the dollar is peaking longer term. And that's going to be a very controversial call, but I think that's what's happening. I think it's going to be a big tailwind for cyclicals.
Thank you, Rob.
Thank
Rob
you.
Sluymer of Fundstrat. What would you rather on this side of the desk?
Well, not Caterpillar. I mean, I hear what Rob is saying. Cats had a move. You go back to their third quarter on October 23rd. It was miserable. Missed on EPS, missed on revenue. And then their prior guidance, which you could drive one of their tractors through, was up from 11. It's true. 11.75 to 12.75 was their guidance. They ratcheted that down to 10.59 to 11.09. So now you have negative EPS growth, and it trades at too big a valuation. So I understand if you think some magical China deal is going to happen, and all of a sudden every rig in the country is going to have a Caterpillar label next to it. I just don't see that happening. I would take profits.
Yeah, listen, I'm not playing your game, but back to his SPX, the S&P 500, and he's calling for a little pullback. Let me tell you this, the December 31st quarterly SPY, that's the ETF that tracks the S&P 500, the at-the-money put is less than $5. That's 1.5%. The S&P is up 24%. If you thought you wanted protection between now and the end of the year, it costs you 1.5%. That's pretty astounding, and it tells you there's a level of complacency right here. And I think you're probably going to be right back towards that, that 300 level or 3,000, I guess, in the S&P.
I think you're going to get a very shallow consolidation.
And I brought it back.
Uh-oh, Dan is so in trouble.
Rolling out of the rest of the
See you guys in the F block.
First of all,
I think Will should take your chair out.
Oh, my goodness.
we'll take Robert all day long.
Thank you again, Rob.